Sometime in January of 2026, with no headline and no vote, index funds quietly took over the American stock market. For the first time, passive funds held more money than every active manager combined. $19.8 trillion against $17.8 trillion. The strange part is how they won. They won by refusing to try. An active fund is a promise. Pay a manager and they will study companies, pick the winners, dodge the losers, and beat the market. An index fund makes no promise at all. It buys every company in the index, weighted by size, and then does nothing. No research team. No stock picking. No opinion about whether a business is any good. For decades that sounded like surrender. Why settle for average when you could hire someone brilliant? The answer is arithmetic, and it is brutal. All investors together own the entire market, so together they must earn exactly the market return before costs. After costs, the average actively managed dollar has to underperform the average passive dollar because it pays more to play. That is not a claim about talent, it is subtraction. A typical active fund can charge 10 or 20 times what a broad index fund charges. That gap comes straight out of your return every single year, whether the manager was right or wrong. Compound a difference like that across 30 years and it stops being a rounding error. It becomes a large part of your retirement. None of this was obvious at the start. When Jack Bogle launched the first index fund for ordinary investors, in August of 1976, Wall Street treated it as a joke. Critics called it Bogle's Folly. Others called it un-American, even unpatriotic, on the theory that settling for the average return was a form of surrender. The launch flopped. Bogle had hoped to raise as much as $150 million. He raised a little over $11 million, which he later described as an abject failure. For years, it looked like a bad idea that simply refused to die. What changed was not marketing, it was time. Index funds never win dramatically in any single year. Roughly a third of active managers beat the market over any given 12 months, which is often enough to look like genuine skill and keep the story alive. The edge only reveals itself when you stack decade on decade and let that fee gap compound quietly in the background. And active managers have not surrendered either. They adapted, repackaging their strategies into cheaper, more tax-efficient exchange-traded funds, a corner of the market that recently passed $1 trillion on its own. The fight is not over, it just moved. For a long time, this was just an argument. Now it is a scoreboard. In 2025, only 38% of active funds beat their passive equivalents after fees, and that was down from 42% the year before. Stretch the window and it gets worse. Over the 10 years ending in 2025, just 21% of active funds both survived and came out ahead. That word, survived, is doing a lot of work. Funds that perform badly get quietly closed or merged into other funds, which flatters the track record of everyone still standing. So the honest question was never whether a brilliant manager exists somewhere. Plenty do. The question is whether you can identify that person in advance, and whether they will still be brilliant after billions of dollars pile into their fund and make it harder to move. Investors answered with their feet. Over the past decade, passive funds pulled in roughly $9.5 trillion, while active funds bled about $600 billion. Passive market share climbed from 34% to 55%. Every year the crossover looked more inevitable, and in January it finally arrived. By May the gap had already widened, with index funds at nearly $22 trillion against under $19 trillion for active. Here is where the story turns. An index fund never decides what anything is worth. It simply buys. But a market only functions because somebody is arguing about value. Prices get set by active investors doing expensive, thankless research, and every index fund quietly rides on the back of that argument. Free riding works beautifully until there are too many riders and not enough arguers. Nobody knows exactly where that line sits, and the honest answer is that we may only find out after we cross it. What we can measure is the concentration. 3 firms, BlackRock, Vanguard, and State Street, are now the single largest shareholder in roughly 88% of the companies in the S&P 500. They did not buy those stakes because they admired the businesses. They bought them because the index said to. And unlike an active manager who can walk away, they largely cannot sell, because selling would mean no longer tracking the index. That makes them close to permanent owners, holding enormous voting power while having very little appetite to use it against management. There is a second, quieter problem. Stocks with heavy passive ownership tend to move together more tightly. When money flows out, the funds sell everything at once, not the overpriced things first, which can amplify a downturn rather than cushion it. None of this makes index funds a trap. For almost anyone saving for retirement, a low-cost, broadly diversified index fund is still the sensible default, and the evidence behind that is overwhelming rather than fashionable. But it is worth being clear about what you are actually buying. You are not buying a judgment that these companies are good. You are buying the market's judgment, whatever it happens to be, mistakes included. When the biggest companies get expensive, your index buys more of them, not less, because it weights by size. That is the deal you signed. The index will not protect you from a bubble. It will faithfully deliver whatever the crowd currently believes at a very low price. That is a genuinely great product. It is simply not the same thing as safety, and that difference tends to only become obvious on the way down. So the boring idea won, and it won completely. It now shapes the very market it was designed to quietly copy. The whole promise of an index fund was to never make a bet. Its success may turn out to be the largest bet anyone ever made.